Many economists predicted a recession in 2023 that, from the headline numbers at least, hasn't appeared. The most recent GDP data released yesterday again suggests the economy is stronger than many believed. Are economic fears overblown, or does recession still loom? We'll discuss the data with my good friend and colleague, Professor Mark Guthner of RUTGERS, today on Open Interest. Hi there. So we're going to bring Mark in, and we are going to get to a conversation about what the economic data suggests might be the right course of action if you are an investor in the stock market. But first, let me welcome my good friend and colleague, co-author of The Options Edge, Mark Guthner. Mark, how are you?
I'm wonderful, Mike. Good to see you again. We got to do more of these.
Yes, I agree entirely. This is kind of an interesting situation, I think, that we're finding ourselves in, because at this time a year ago, a number of market strategists, clearly Morgan Stanley was maybe among the most notable. A lot of people had a very bearish outlook for stocks and a fairly gloomy forecast for the U.S. economy. And yet the headline numbers have actually consistently been, I think, better than a lot of people expected. And obviously I want to talk about what the implications are for investors in the stock market, for investors in the bond market, and maybe we can also discuss what the implications are for real estate. But I think it's important here for us to just sort of frame the whole question first by taking a look at some of the data, and you have some thoughts on this and some slides that you think might shed some light on where we are right now.
Yeah, I'd like to talk about those. But before we jump to that, why don't we do a little recap? If you recall, about a year and a half, 2 years ago, when rates were very low, we were predicting much higher rates because we were looking for higher inflation. And our view was that that would cause a stock market sell-off, but the economy would not slow down, principally because if the Fed is forcing rates down to close to zero, so short-term rates were zero, I think the 10-year bond rate bottomed at about 50 basis points. Those were unnatural rates. And so when they were going to go back to something normal, like 4 or 5, to my mind anyway, that was neutral. 0 to 50 basis points was your foot on the accelerator. And just because you take the foot off the accelerator doesn't mean you're going to slow down. You can coast for an awful long time. So the U.S. economy is very resilient. So to my mind, the economy was going to keep chugging along. But we were going to see higher inflation numbers and higher interest rates. And so the knee-jerk reaction was, and we expected rates to fall, stock prices to fall. But then eventually recover as people figured out, hey, we're not going into recession. And that kind of played out. On the other hand, from my personal view, is I've been a little surprised at the strength of the rally we've had in the last couple of months of last year. So it'll be interesting kind of what happens going forward from here. But I'm still not looking for recession.
Yeah, I think an important thing that I would bring up, one of the concerns, of course, that investors have is that when you look at equity prices in particular, when you go into a recession, generally speaking, in history, a couple of things would happen. One is that corporate earnings did not expand or improve, and you didn't typically, during a recession, get multiple expansion. So you put those two together, and it's unlikely that you're going to see stock prices advance meaningfully. So that's one important point. And there's something else I was just going to talk about, and we can get to that. And that is that we usually look as a bellwether for the stock market to the S&P 500. And the S&P 500, my views about how the S&P 500 behaves over time is different than how I view stocks more generally. because the S&P 500 and other indices like it are kind of a special construct, and we're going to get to that. But why don't you share with us some of your thoughts about the implications for interest rates, the change in interest rates, and how that's really affecting things like government borrowing?
Sure. Yeah, let's dig into it. So the first chart I'd like to show here is a chart of the public debt, and the public debt just goes up every year because the government borrows more money every year to balance its budget. We had a very brief period during the Clinton administration where we ran a bit of a surplus, and so that was a good time. Most people forget that that was during the dot-com bubble, and the government brought in egads of capital gains taxes as people were cashing in on their dot-com stocks, companies that were essentially going public at valuations of 10 million, 20 million, 100 million, and then quickly trading up to 10 billion, dumping the stocks, taking their profits. And the government was one of the big beneficiaries of all that, and of course they were kind of got roughed up like everybody else when that bubble popped. But and of course we have this little area in the gray band in 2020 where we had, I guess technically speaking, maybe a quarter of negative GDP, not really a recession to my book. And during COVID, the government borrowed a ton of money and just handed it out to everybody. And we got our stimmies, and our Wall Street bet friends used that money to play GameStop and other fun things. But even since that time, the government has kept up heavy borrowing and heavy spending. It's hard to have a recession when the government is so aggressively expanding its spending. So I don't expect the debt to come back down. It's just going to grow. The question is at what rate? But it has real implications on their income statement, if you will, the government's income statement. And that's the interest expense here. So interest expense, notice in the last chart that debt was going up every year, but the interest expense kind of flattened out there from about 1980 to, let's call it 2015. And that's because interest rates were falling at the, about as fast as debt was going up. And the government was kind of getting a bit of a free ride, and stocks were getting a bit of a free ride because stock prices are going to go up, generally speaking, in a falling interest rate environment. If that falling interest rate environment has to do with a falling of inflation and inflation expectations. But as you can see on the far right hand of this chart, that interest expense has exploded as debt service and interest expenses has gone up from very nominal sums to quite high numbers. So I think the 10-year bond yield now is about 10.1%, peaked a little over 5%. T-bills are about 5 to 5.5%. And the chatter continuously in financial news is that those rates are going to come back down. I'm not so sure, but at the same time, I don't think it's a disaster if rates don't come back down. So let's walk on to the next chart, because this will be a little bit helpful. We can see how interest rates kind of fell continuously and how this helped the government. So this chart here, I got this data from Fred, which is a database provided by the Federal Reserve. And I took the interest expense of the government and divided it by their debt outstanding. And you can see the average interest rate paid just monotonously and monotonically falling. And that number hit a bottom a few years back. And now I believe it's going to be on the way up. And it's going to be on the way up for a long time. This is one of the things I talk about to my students. I say, I enjoyed the benefits. I came out of school, and during my investment career, interest rates were falling, so you made money on bonds, and you made a lot of money on stocks. It's a beautiful time to have money in financial assets. They're going to have a harder time because we'll probably, on a longer term basis, not necessarily the next year or two or whatever, but over the next 10, 20 years, rates are going to have a bit of an upward tilt or an upward bias to them. How fast just really depends upon inflation and how well our government balances its budget. Let's go on to the next slide. This is a little interesting. I like to watch income taxes collected as an indicator of how the economy is doing. So if everybody's working hard, companies are making money, the government's going to collect a lot of income taxes. And this is personal income tax in this chart here. Notice that it rocketed up and it's come back down. I don't think that's much of a concern yet, simply because government payments, special payments from stimulus checks and all that type of stuff has come off. And so that little extra bit of money has come off. But you can see it's on a nice trend of moving up. So I expect the government to collect more money in income taxes as I expect the economy to continue to grow, more people to work, and hopefully earn higher wages. The question is how did that balance out relative to the government's debt service expenses? And this is a chart here that shows the interest expense of the government divided by the income tax collected. And this is we're kind of getting in ominous territory here because about 40% of the personal income tax collected is going, it's a little more than that, it's 45%, is going simply to make interest payments by the federal government. That's not very tenable, and it means that the government in time will not be able to provide the goods and services that it typically does, through the welfare issues and people that need a hand, and infrastructure investment and all these kind of things that the government does. So there's going to be a tug of war here, I think, in the years ahead about how we fund the government and what the priorities of the government are going to be. And in that mix is going to be this big, ugly number that you can't negotiate with. And a lot of people think, that I talk to, think that this is a reason why the Fed will force interest rates down again. They got to get that interest rate down in order to get the interest expense down. But they've got to fight market forces. And if the government's going to issue $1.5 trillion or $2 trillion a year debt, which it looks like it's going to do for the next couple of years, you're going to have to find somebody in the private sector to buy that debt. And you're going to have to, and to do that, you're going to have to pay a fair rate of interest. So that's the way I'm thinking about it. So net, I'm not looking for interest rates to fall as the same as the financial media and political pundits out there are saying. But by the same token, I don't think that's a terrible thing, because I think interest rates at this point in time are closer to neutral than anything else. I don't think we have tight monetary policy yet. And so I don't see Fed action something that steps on the economy.
Yeah, so it's interesting. You're talking about Fed action. There's a couple key drivers, I think, for interest rates. Obviously, people think about rates as being guided by the Fed. And of course, meaningfully, they are. But there are other forces. The Fed is often acting in response to those other forces. And mostly what we're talking about are inflationary forces. So the nearly 40-year bull market that we saw in bonds began when rates hit their zenith. That zenith was what Paul Volcker did to control the inflation that started in the 1970s and continued through the very early 1980s, so up until I think about 1981. So we had that very high rate of interest, and then we had a whole bunch of forces essentially that have kept a lid on inflation since. And then Fed policy at the tail end of that. So first of all, the high rates brought inflation down. It created a recession, created deflationary forces, so that reduced inflation. But there were some other really important drivers during this period as well. In the early 1990s, for example, when Bill Clinton was president, you referenced the fact that the federal budget actually, on a cash basis, saw a minor surplus. I mean, that didn't deal with the unfunded liabilities. The reason for that was in part because Congress actually decided in the 1990s, didn't they, that they were going to try to be more responsible. I think it was when Newt Gingrich was Speaker, they had this idea, the contract with America, where they said, we're going to try to balance the budget. And I think that was in around 1994. They actually had sort of a pay-to-play rule where if you wanted to come up with some new spending, you had to find some other place to cut, or you had to come up with taxes. And that was basically rules that Congress imposed upon itself. And of course, all will know that Congress is the one that ultimately controls the federal checkbook. And then I believe it was in 1997 or thereabouts, John Kasich, it had to do with healthcare spending. He again had this sort of balanced budget proposal so that they were going to make sure that they did not increase the deficit, did not increase the debt with those efforts. So we had deflationary pressures initiated by Volcker. We had a measure of fiscal restraint in Washington, which is almost inconceivable now.
That's
and
right.
in the midst of all of this, we also had globalization. So, we had sort of an expanding economy. The Cold War was largely over. Some countries became free market. We saw a lot more trade with China. This is arguably one of the biggest deflationary impacts that we could have had, that we saw increasingly manufacturing moving to low-cost places around the world, and trade increased. All of those were massive deflationary impacts, essentially. And so that helped permit this decline in interest rates. And at the tail end of that, and let's just say that we got to a natural interest rate of call it 4%, right? So that the right rate on the 10-year U.S. Treasury would be, say, 4%, so that there would be some nominal real rate of return and a relatively low inflation rate. That gets us back to the rates that we saw, I think, in the late 1950s. Then we have the GFC. We have the Great Financial Crisis, and the government and the Fed, I'll separate them for now, both respond very, very aggressively to that. The deficit explodes. There's massive fiscal spending. The rules that Congress had put into place in the 1990s, essentially those pay-to-play rules, had sunset by then. So there was no real restraint on congressional spending. And then you had the Fed say, okay, well, we're going to just push rates, the Fed and other central banks, we're going to push rates essentially to zero. So all of a sudden, you no longer have a real interest rate. You don't have real reasons for rates to decline. They're being forced lower.
Yeah.
And the natural course, now that was not hugely inflationary at the time because of the GFC itself. The GFC was a deflationary impact. You had a lot of bad debt, and that bad debt imploded. And so that was kind of an offset. You could get away with heavy fiscal spending. You could get away with easy money because you had a deflationary pressure as a result of this debt implosion, right? So essentially, you were adding to the money supply in one area, but it was declining in another. Now, of course, we find ourselves in a very different set of circumstances. Empowered to just print money, now we have a situation where they did that, but not when we had a debt implosion. Instead, we had an implosion of goods production, right? So the economy was grinding to a halt, and we threw all this money at the problem. So all of a sudden, there's more money and there's fewer goods.
Yeah.
Economics 101, increase of demand, decrease of supply. inflation is the necessary result. But something else is now happening after the pandemic, which is that geopolitical risks with places like China now have major companies saying, well, wait a minute, maybe doing business in China isn't the best idea. You know, we see Taiwan Semi, okay, we're going to start manufacturing in the United States, for example, rather than China. So if companies are going to say, we're not going to go to the lowest cost place to produce, but the lowest cost price to produce that is also geopolitically safe, that is by definition going to be at or higher than their current cost. So that is not deflationary, that is potentially inflationary. Now, inflation data does, for the time being, appear to be okay. But I guess my question is, if you can't have really low inflation, you know, people get concerned about deflation, and I could understand that if you are believing that for economic reasons. But a lot of the tailwinds that helped keep inflation low no longer exist. We do not have fiscal responsibility in Washington anymore, as you just demonstrated. We do not have the tailwind of lowest cost production in globalization anymore. So that too is a potential problem. And of course, we also have massive debt issuance. So that is a problem. What are the implications for companies if, you know, you were a company that wasn't like Apple or one of these other companies that just grew astronomically over the course of the last couple of decades, but you're kind of treading water. Revenues have been relatively flat. You've borrowed a lot of capital, and you've been able to do so because year after year, rates fell. You could either see your interest rate decrease over time, or you could just borrow more money, pay off your old debts, reduce, and take on more debts. But your interest expense as a business didn't necessarily expand. What are the implications for those kinds of businesses in this new rate environment that you think we might be looking at?
Well, they're going to have to find a new way to compete, and that's going to be a tall order. You could be a little bit lazy to get your share price up by borrowing money at 2 or 3%, then buying back your stock when the cost of equity is 8 or 10%. So you've got this arbitrage, and you just keep buying back stock every year, and that's what makes your share price go up, and everybody's happy. Now, if you've got to start sharing those returns on equity over to your bondholders, and now you've got to pay them 5, 6, 7%, the returns to equity holders are going to be lower. If we look at the last 100 years, the average geometric return of the S&P 500 was 10% a year. Right around there, maybe a few basis points short. But since the great financial crisis, it's been 13.5%. So if you believe in a reversion to the mean, we might expect the S&P 500 to return something like 5 or 6% for the next 10 years to balance out and get back to that 10% long-term mean. That's the kind of thing that I'm looking for at this stage of the game. I'm not looking for a crash or anything, horrendous happening. It's just, to my mind, I would expect a reversion to the mean as interest rates revert to their mean, and this automatic stimulus is just going to have to be taken away. The government can't spend its $2 trillion forever. Somebody has to buy that debt, and if the Fed
default rates too, I assume. We have, as interest rates fell, so did default rates. So corporate default rates fell below their long-term mean as well. That was facilitated by declining rates. As the cost of capital declined, sort of monotonically over decades, companies could, there's a term for it. They could extend and pretend, right? Potentially what would, under normal circumstances, in a flat rate environment, or even and certainly in a rising rate environment, be zombie companies. They're sort of the walking dead. That if rates do not continue to decline, And there's a functional floor. It seems like we reached that during the pandemic at the 50 basis point level in the 10-year, as you pointed out. So let me just bring up something you were just talking about with respect to how the S&P has done over time and what we might expect. So I think a lot of people who talk the way you and I do about debt, the problems that it creates, inflation, the problem that creates, people think that we're just predicting some kind of an equity market crash. I want to make a quick point about the S&P 500 because I describe it as a bellwether for the economy. It is not a bellwether for the economy. The S&P 500 is what I like to refer to as the publicly traded all-stars in our economy. So, what we're looking at here is a table. It's just 20 years apart. What the S&P 500 looked like in 2001, which was sort of after the tech bubble, the biggest companies, the most successful companies, and then what it looked like 20 years later. Now, of course, anybody who's thinking about the S&P 500 today, they think about the Mag 7. Those are the largest companies. And one of the interesting things about a market cap weighted index that is the largest companies is that the winners are always going to enter into that index. The losers will fall out. And the better they do, the more weight they carry. And one of the impacts of that is that the earnings for the S&P 500 as a group will grow more quickly than the economy does. So what we have here is, I think, it's about a 30-year chart of S&P earnings. And of course, you can see that there were some notable pullbacks that took place. And actually, this goes to something I said earlier, which is that observe in the early part here, we're looking at the early 90s on this chart. People will remember George Herbert Walker Bush, that is, did not get reelected. Bill Clinton got elected. Some people cite the fact that he had said, read my lips, no new taxes, and then there were tax increases because, remember, there was actually some fiscal and spending responsibility in those days. Another is, of course, that we went into a recession in the 1991 timeframe. Notice that S&P earnings actually fell around that time. And you'll also notice that in subsequent economic downturns, we saw falls. Some of the biggest falls we saw took place, obviously, during the Great Financial Crisis. There was a notable fall off. We saw, obviously, declines at other recessionary periods. The pandemic, needless to say, caused a sharp decline as well. But if we smooth this whole thing out, this represents more than 7% growth year over year in S&P earnings, if you just smooth this whole thing out. And that compares to nominal GDP. So I'm not adjusting it for inflation, but that compares to nominal GDP growth for the U.S. economy of less than 5%. It's probably about 4.8. So what that tells us is that the S&P, just over the long term, our expectation is that the S&P should grow faster than the economy does. And if you're going to invest in equities, and I think everybody who's a long-term investor should hold equities in their portfolio, just understand that dynamic, that we can have concerns about fiscal debt and deficits. We can have concerns about rising interest rates. We can have concerns about the implications of those higher rates and capital costs on companies that have to bear those interest rate expenses. So Russell 2000 companies, for example. But in some ways, those rate implications don't play to the biggest constituents of the S&P that essentially are just cash-generating machines. Microsoft, Apple, Google / Alphabet, Meta, these companies throw off massive amounts of cash. They are not compelled to borrow money if they don't want to. They were able to do so to their own advantage when rates were low, right?
Well, that's right. I think the big companies are going to win. I think we're going to still see the Microsofts, the Apples and so forth that are huge cash generators continuing to do so. I think the point you make that earnings growing faster than GDP makes perfect sense, because think about you as a manager of a company. One of the things that you're going to try to do is lower cost, improves productivity. So if you think about earnings, earnings should reflect both the growth in the economy plus some productivity gains. And so one would expect the best companies to do that. I don't know anybody whose business strategy is to run a sloppy operation and have higher expenses, right? Everybody wants to do what they're doing more efficiently, because then either they can offer a lower price to their customers, sell more product, get economies of scale, and then improve profitability, returns on equity, and returns on assets. So I think that the point is well taken, and one that people forget. Now, if we didn't have so much monetary inflation, we certainly wouldn't have so much price inflation, right? Because prices, the natural course of business of prices in a business where there's not monetary inflation is that prices should stay stable in aggregate, or fall at the margin as people try to produce more efficiently.
Yeah, I mean, something like a television, for example. If we didn't have any inflation, those prices, they have fallen significantly. Flat panel televisions, for example, in real terms, those prices have fallen significantly. In nominal terms, they have fallen significantly. The earliest flat screen televisions were $15,000, $20,000 for a 50-inch TV. Now you can get one for $500. So it's not even close. So one thing I was hoping to get your opinion on, and you're in academia now, and one of the things about being in academia is that the tuition that university, even though yours is a public university, Rutgers, those prices just keep going up and up and up, and oftentimes they're going up faster than the rate of inflation. They're going up faster than the growth in the economy, and so maybe that creates a more insular world for academics. And I keep hearing a lot of people in academia talking about how the economy is really much stronger than people are giving it credit for. And the reason I say giving credit for it is because there seems to be a big difference between headline economic data, like the GDP data that we got this week that showed 3.2% GDP growth, and what surveys suggest people are feeling or experiencing. And we are seeing things like consumer debt levels increasing. We are seeing things like delinquencies, for example, auto loan delinquencies and things like that are rising. There seems to be some increase as well on the revolving credit side. We have also seen, and this I think is very interesting, people keep citing inflation. When people think about the state of the economy, they look to the GDP growth. That's an important part. They look to unemployment, like the headline unemployment figure, which is quite low. So both of these numbers at a high level look good. And oftentimes they're looking for wage gains. So the wage gain picture hasn't been quite as good. It seems like a lot of the unemployment and non-farm payroll data, it's consistently, the revisions are lower. And I was looking at one of the numbers from 2023, and it seemed like a lot of these jobs are coming, actually, they're government jobs, right? So private sector jobs and private sector wage growth is actually maybe not as good as the high level number suggests, because you have a lot of government jobs coming in, you have a lot of healthcare jobs, and a lot of healthcare, of course, that money essentially, that it can be in the private sector, but it's flowing through a public channel, right? So it's not a manufacturing job. Let's put it that way. So you're not making anything by this. So I guess my question is, with that as a backdrop, how can the economy really be that strong in real terms? If all of the the non-farm payrolls are getting revised lower. If the real job growth is only happening in the government sector or something close to it, and again, like I say, I'm asking somebody in academia. You guys probably aren't seeing any layoffs at the university.
No, we're not. But I would say this: GDP kind of tells us what the economy is doing, how much people are spending. But it does, and so it's a measure. I like to think of it more of a measure of net sales for the country. It's not a measure of wealth creation. So a perfect example of that is defense spending. So in defense spending, you go and you make a bomb and then you go blow it up. So there's no difference to that than hiring somebody to dig a ditch and then hiring somebody else to go fill in the ditch. Everybody's getting paid. Those numbers show up in the GDP, but no wealth is created. In fact, wealth is destroyed. And this also brings me back when I was having this thought that Bill Clinton also had, if you recall, they called it the peace dividend post-Reagan. That we're no longer fighting a Cold War. Everybody chills out. The real defense spending was falling pretty fast. And so when money was being spent, it was being spent on real productive capacity of the economy, and so real wealth was being created. So just because we have a high GDP number doesn't mean people's wealth is going up. If your income goes up by 10%, but the inflation rate is 15, the employment number hasn't changed, but your wealth is being pinched in that situation. And that's kind of why I think there's a dichotomy between sort of the way the academics and maybe the financial pundits talk about, and the political types talk about the economy, and the pain that a lot of people are feeling that they can't pay their bills all of a sudden because the price of everything is going up. I was just watching a show. I think maybe it was CNBC. I forget this morning, but they were talking about how insurance companies are raising prices anywhere from 15 to 30% on cars and homes, and they're leaving a lot of markets because they don't want to insure in those markets anymore because the cost of doing so.
That's actually happening. It's funny you mentioned that. That's been happening here. It's very difficult to get a fire insurance on homes in a lot of areas of California, including this one. And it's also interesting you mentioned the auto insurance thing. I've seen that myself. I just got some revisions. We've never filed a claim on our auto insurance, and our policy expense went up quite notably. And unfortunately, I have another teenage driver who's going to be joining our household as a licensed driver soon, and I'm really not looking forward to that. Well, this has really been a good conversation. I guess the key takeaways are, number one, that a real bull market in bonds is not probably what people should hang their hat on if they are investing either in fixed income or in real estate or any risk asset or stocks for that matter. The best companies with the big moats are probably going to continue to grow and grow faster than the headline GDP number. I guess that's one of our key takeaways. And another key takeaway is that if you are one of those people sitting at home and thinking about this the way that Mark and I do, that the GDP data and the unemployment data, it tells us some things, but it misses a lot of things too with respect to wealth creation and why it is that many of us don't feel like the economy is as healthy as those numbers at a high level suggest that they are. I really appreciate your time today, Mark, and I hope we get a chance to do this again really soon. Thanks for watching.
Okay, see you next time. Next.